What if I told you that real estate investing can be easy? What if I told you that to be a successful real estate investor, you don't need to become an expert entrepreneur with a vast network, incredible competences, and willing to get up at 5 in the morning to go fix the plumbing of unhappy tenants? Today, you're going to learn about a new way of investing in real estate, one where you can start with just €100, diversify across multiple properties, and benefit from the higher profitability of short-term rental without having to do all the work. In this episode, we dive into all the details of how that is possible, all the pros, the cons, and the limitations in this fascinating interview with François Kiesecoms, the founder of Scargo. Let's go. For those of you who know me and have been following FIRE Belgium, you probably already know that I'm not a big fan of traditional real estate. And that's because it comes with many disadvantages, especially when compared to something so simple and effective and powerful as index investing. Being successful with traditional real estate is not impossible. As a matter of fact, I do believe that there are ways of getting great returns with real estate, but it does require specific knowledge and competences, as well as a lot of upfront research and usually also quite a bit of work throughout. And all that to most often get fairly stable returns, but nothing extraordinary. In comparison to that, index investing provides a simple and effective way, evidence-based, research-backed approach to become a shareholder in hundreds or thousands of companies around the world in just a few clicks. So you get maximal diversification at the lowest possible cost. It's proven to deliver better results than active management by decades of academic research and statistics. It's really hard to beat, hence why I'm such a big fan of it, obviously. Now, if you're new to index investing and you want to learn more about how it works and how you can get started, I recommend you check the free workshop that is available on the FIRE Belgium website and for which I will provide a link in the description. But today is not about index investing. Today, we talk about a really interesting, fairly innovative approach to investing in real estate without all the hassle. Today, we talk about fractional real estate, or how to become part owner in a real estate property. And to help us with that, I have invited François Kiesecoms, the CEO and founder of Scargo, a startup that aims to make real estate simple, effective, and affordable for all Belgians. I've met François through my friend Kilian, and together they've managed to convince me that fractional real estate is a very interesting approach as it deals with many of the challenges of traditional real estate. In a way, and as you will see in this conversation, this is a way of investing that brings real estate closer to the simplicity of index investing. And I love that. And while it doesn't change my personal investment strategy and my personal conviction that index investing is the most effective way of doing that, I still think it's worth exploring, especially for those of you who really want to be in real estate. And with that, I bring you François, founder and CEO of Scargo. So François, welcome to the FIRE Belgium Show.
Hello, Sebastian. Thank you for having me.
It's great to have you here because real estate is a big topic in the community. It's been a big topic at some point in my own personal journey as well. When I was looking for ways to invest, I did consider real estate, and it's something that seemed so daunting because the more I was reading about this, the more I realized it was really difficult to do it well. Real estate requires a lot of work, a lot of research, a significant network, and then quite a bit of luck too, because good deals can also go bad. And yeah, it's a significant risk. So real estate is really something that's been part of my journey. But since I've discovered index investing, I couldn't find reasons why going to real estate the traditional way, right? And that is when people buy a house or an apartment and then rent it out. But so let's start there then. Maybe why do people invest in real estate in general? And why do you think it's important?
Of course. Okay. So yeah, I think real estate has always been a big thing, especially in Belgium. Well, everyone know that if you leave your money on saving accounts, right, in Belgium you get rates lower than 1%. So you have to do something with it, otherwise you're just wasting money, right? Especially with the inflation we have now. So if you look at the alternatives, you have the stock market, which can be stressful for people that are not used to it because shares are volatile. Then you have crypto. I don't know what you think about crypto.
Not a big fan.
Not a big fan, but sure, not easy for everyone to understand, and I believe it comes with some risk also. And so what most Belgians do is that they turn to real estate. It's still the most stable and secure investment you can do long term, or at least the more stable and secure alternative to the saving account. It's easy for everyone to understand, and return can be interesting, especially if you use debt as a leverage. So I think those three reasons is really why you see so many Belgians turning to real estate as an alternative to the saving accounts.
Yeah, and I think the second reason you gave there, the fact that people understand what it is, to me that seems to be the biggest factor. And I'm not so sure that people actually get the returns that we hear about. My understanding is that people who go into real estate don't necessarily get those returns, but that's often, I feel like we have a savings account and then we have a real estate, and that's kind of the only two ways of investing, and everything else seems super risky, because
Indeed.
for people the alternative would be, oh, we're going to pick one stock or one company, one startup, or a crypto coin. and all of those are extremely risky. Obviously each of them individually they are, right? And real estate at an individual unit seems a lot less risky also because it's tangible, it's something, something hard. And
Exactly.
if the underworld happens, you still have something
the bricks, right?
that can be useful. So I think there's certainly something like very important there. I think long term, there's some data that suggests that long term real estate, like the value of properties, rise alongside inflation. Now, yes, debt can be a powerful tool if used correctly, and in some cases, and it depends a lot also as well, I would say, on maintenance and costs and all of these things. Anyway, I have a lot of arguments, not so much of it in favor, especially since I discovered index investing. So I thought we start by this. We'll talk. Obviously, this is not it's not a conversation about real estate the traditional way, but I'd like to highlight why I thought, well, until now, I still think the traditional way isn't the way, especially compared to index investing. So index investing is extremely passive, right? Whereas real estate does require some work. Index investing is, you get maximum diversification in just a couple of clicks, whereas diversification in real estate, it's pretty poor because you get one house first or one apartment first. That's the traditional way. It's like that. No, you put a lot of your money in one place, and if something goes wrong there, whether it's regulations or tenants or some other issue, it can hurt. The time to start index investing is very fast. Real estate can take a long time. The time it takes to maintain, again, real estate is quite take a bit of work, but it can also be outsourced and not very effective. More time effective, but maybe less cost effective. And the starting capital required is also quite different for real estate compared to index investing. Anyway, there's a huge list of benefits for index investing compared to real estate in general. But the reason I want to talk to you today is because you're bringing a new way of investing to real estate. You're developing a new way of doing that. It sort of exists already around the world. There are some other providers in Belgium, but you're doing it slightly differently. But certainly, to me, you've brought something new that's called fractional real estate, and that I wasn't really aware of before. And so that's why I invited you on this podcast, because I think it can be an interesting alternative for many people who don't find their solution in index investing or traditional real estate for all the reasons that we talked about. What you've explained to me so far seems to be an interesting alternative, and I'd love to explore that with you in this podcast. And so, could you tell us a bit more about fractional real estate, what it is and how it works?
Yes, of course. So before I go into fractional real estate, I totally agree on your analysis when you compare index investing and direct real estate. If I sum up the main disadvantages of buying a property, it's mainly the capital you have to bring, right? Then the lack of diversification and the fact that you have to have inside knowledge to do it right and get the returns that you expect. So on all of that front, I think we're on the same plan. So what is fractional real estate? So fractional real estate is the idea of splitting a property, a real estate property, into smaller shares that everyone can buy and hold, so that they can get a fraction of the rent every month and a fraction of the capital gains once we sell the property. So it's really the idea of giving access to an asset class, a property, to everyone. And it's something, fractional investing is nothing new, right? So you said there are companies that exist. It's a real trend that has been here for a while, especially in the United States, with two companies that drive it, I would say. One is Masterworks. I don't know if you've heard of that.
No.
But I do fractional investing in art. So you can buy a piece of art, hold it, and hope for capital gains a few years down the line. So it's again, it is an alternative asset class that was very interesting, but that was difficult for anyone with small savings to get into. And so that was really the idea of the company. Then there is one that's called Rally, and they do fractional investing in vintage cars. Again, those two companies and a few others have really made that mainstream, I would say. But now there are companies like Scargo that apply that fractional investing to real estate. Because we think that, again, it's an asset class that can be financially interesting, but with very high barriers to do it well, that you've discussed before. So this is all about it. Buying a property with 100, 200, 300 investors, split the rent, so you can invest smaller amounts, hope for a capital gains once you sell the property down the line, and so you can also diversify, and it's mainly a passive investment usually. So that's what fractional real estate is.
Yeah, so in a way, it's kind of what funds and ETFs do for investing in the stock market, in a way, no, in the sense that you can basically pool your money together to buy investments on the stock market. That's kind of what investment funds are, and ETFs are essentially a way of buying shares of those funds through the stock market. And so if you want to make an analogy here, which is we're not quite there yet in terms of scale and all that and diversification, but Scargo could be seen as a place where you can buy shares of properties one at a time, I guess, for now. And maybe someday could we imagine funds of properties, and people could just say, hey, I just want to buy Scargo Antwerp, and there's 20 properties in there and you get one share of the whole thing. Would that I know this is is that something that you think is possible, like more of a pooled like collection of properties that you can just buy in one go? Is that something?
Yeah, actually those have been existing for years and years. They're actually called in the United States REITs.
Oh yeah, so that would be on the stock market, right? Real estate investment trusts.
Yeah,
but you can also buy them through investment companies that then manage portfolios like that. Okay,
exactly.
Right.
You either have funds that manage a portfolio of REITs, or you have REITs themselves that are either publicly quoted or publicly traded or not. In Belgium, there are 17 of them, and we call them FIRE, which in French is Société Immobilière Réglementée. But basically, it's just a REIT, but with a specific status in Belgium that's controlled by the financial authorities. In Belgium, they're all publicly traded. And what it is exactly is that you're buying shares of a fund that includes can include thousands of properties. So you're buying really a share of a diversified portfolio, right? And these are publicly traded. I would say the big difference with Cargo is with Cargo, we want our investors to be able to pick the properties they like and build their own strategy, and to be able to know what they are buying, so they can see the business plan, they can decide whether it's a property they want to get into or not, and they can really build their own portfolio. So I would say they build the diversification, it is not done for them. And I would say also a big difference is that in Belgium, all the REITs are publicly traded. There are 17 of them, they're all publicly traded, which means that it's like buying a share in the stock market, right? It comes with volatility, and that can impact your returns long term. If you had bought, for example, at the beginning of COVID, I don't know if some people did, where there were a huge crash. The share price of all the REITs went down, even though the value of the assets within the funds didn't change. And so if you had bought there, your returns long term wouldn't be impacted. So
would that be long-term returns impacted or just short-term returns? Because obviously it goes down, but then if the value in the fund is what it is, if you hold, there shouldn't be an issue.
I guess if you hold long term enough, you will recover. But what I mean is that it's going to take a few years, right, so that it goes back to the level of the assets.
Okay.
At least that's what we saw in the evolution of the share price.
All
So
right.
what I meant is that with cargo, there is you're buying a piece of a property that with value is going to be stable over time, and it's not publicly traded. So these are rates, and indeed it has been. I mean, funds like that have been there for quite a long time. So we're not reinventing this.
Yeah. Okay. So what you're doing, well, basically REITs are typically also commercial real estate, I would say. Maybe not the sorry, the private houses or apartments that you're targeting with Scargo. And yeah, they are quoted on the stock market. They've been there for a while. They tend to be large. And when you buy an entire, like a share of a fund, and you don't really decide, you don't have that power of decision of whether to buy that piece of property or not. Whereas my understanding is with Scargo, you give access to specific properties to each investors. They can just say, I like this one in this market. I like that one in that city. I like this one in this neighbor. I like this one because it's, I don't know, short-term, long-term, it's small, big, whatever. And people can make choices on the properties they like most, right?
Exactly. That's a great sum up.
Yeah. And the fact that all of that stays private because it's only through Scargo that these are available.
Exactly.
Okay, very good. And then we were looking at other alternatives as well, and you mentioned a few when we were preparing the call. What are the other alternatives?
Yeah, there was one other I see. It's loan to property developers. So if you go out there on crowdfunding platforms, some of them have a category where they present real estate. And what you can find there is loan you can do to property developers. So what they do mainly is that it's developers that want to build a new building, for example, they get part of the money from the bank through a bank loan. They bring in some capital usually, and then they complement the money they need with the crowd. And in exchange, you get so it's a loan, and you get a fixed interest rate, usually for a period of 24 to 32 months. So that's something that has been there for a few years or so. It is a nice way to also get access to some sort of real estate. I would say the main difference with what we have to offer here is that you're financing a new project, and that comes with its own risk. While with Cargo, you're actually investing in a property that's going to be rented tomorrow, long term, and you don't have any risk of building. Actually,
the construction risk is not there because it already is built.
Exactly.
And when you loan money to a property developer, for example, through a crowdfunding platform for real estate projects, you're not actually owning the project because you are loaning money to the owner. So you're not the owner, right? You don't own the building, and it's basically a loan. It's like a bond to a government, but more of a loan to a corporation. So from in index investing terms, this would be a corporate bond, which is not necessarily something that we like to have in portfolios for index investors because they tend to have higher returns but also higher risks. And the issue with those, I'll just I think it's a good time for me to teach something for those who are looking for high yield bonds. The issue with high yield bonds that are issued by corporations and including real estate developers is that basically you take on the risk of the company, which is similar to share risk. When you own a share in a company, a stock, you own the risk of the company too. If the company does well, you get all the benefits. If the company does poorly, you get all the losses. If the company crashes, you lose everything. And with bonds to those same companies, it's a similar risk in the sense that you could lose as much. You're tied to their performance as much as with stocks practically, but there's a limit on how much can be made, right? The maximum gain is the interest that is written there. And depending on how it's written, you are often the last one to get paid. The other lenders, the bigger lenders, might get paid first, and then the private lenders get paid last. So certainly crowdfunding for projects like this is something to be careful about, because it's nice when it works well. The moment the markets are struggling, these are the ones that I think tend to default first. And so for index investors out there, don't replace your bonds with high yield bonds, corporate bonds. That's risky. But so Scargo is not at all like this. Also, Scargo provides ownership rather than just a loan to property developers. So it's quite different indeed. But yeah, when obviously Scargo has elements of crowdfunding in the sense that it is open to the crowd to bring together the money to acquire the property, but it's really the acquisition, and the crowd is then owner of it, a part owner, which is not always the case with the other projects. So we see crowdfunding projects is often loans to businesses with fixed interests, and loan to projects, and so obviously there's a risk related to simply the successful development of that project. Whereas in this case, the property exists. The risk is more in the how is the property going to perform in the future, which tends to be a lot smaller risk than is this project actually going to succeed.
Yes, that's the word I did.
Yeah,
I will come back on that maybe later, on what people are buying exactly. So I wouldn't say the legally owner is the right term, but we replicate what the owner would make. But I can come back on that back later.
Or we can cover that now if you want. I mean, I think it's a good time to clarify, because we are comparing with the loan. Yeah.
Okay, with pleasure. So indeed, with Cargo, the difference is that you're not loaning to a property developers and getting a fixed interest rate, but you're not legally an owner of the property neither. But you're actually, because, I mean, we thought about that, right? That's what we wanted to do at first, but then we thought, okay, what if 200 or 300 people own a title of property to a house? They will all have to go and sign on the notary. They will all have to vote if we want to fix the garage door because it's broken. And if they want to get out of there and resell the title of ownership, the buyer of this title has to go to the notary, pay taxes, because in Belgium, when you buy real estate, you do, right? And so that would make the process very complex, especially if you want just to resell a few fractions of real estate that are worth €1,000, right? So to avoid all of those problems, we have to figure out the solution. So we've been working for 8 months now towards a solution with notaries and lawyers, and this is a real estate certificate. So basically, what we offer to people is still a debt instrument, but it's not a fixed interest rate. It is it's a debt instrument, a contract that will give you 100% of the revenues that the property is going to generate. So that is all the rent minus the charges and the reimbursement of the debt, if there is one, right? Because we contract a loan to buy the property also, and the capital gains once we sell the property. So basically, which legally Scargo stays the owner of the company that buys the property, but Scargo does not have any revenues of the property. They all go towards the investors who get the whole leverage, and that's the best way we found to make this happen.
Mm. Yeah, that's an interesting structure. So when it's shared ownership, it's actually very complicated in terms of the transaction and then the maintenance, agreeing on things. Whereas in this case, investors would basically own, how do you call them, the certificates, which entitle them to the revenue from the property, both rent and sale capital gains, for example, or
Exactly.
the sale value. but they delegate then the management to Scargo, right?
Exactly.
Okay, so
Exactly
it's a
it.
way of being of it's a practically full passive ownership of real estate.
Yes, exactly. It's totally passive. You don't have to. I mean, it's 100% transparent. You can see the business plan before investing. You can see the photos, but you can see the numbers, everything. But once you give your go and invest, then Scargo is taking care of everything, managing the property, selling it, and everything is written within the real estate certificate, which is a long 10 pages to contract that I can try to summarize, but it is clearly written how we're going to manage this. You can see the numbers, and you can see, for example, we're going to sell the property within a 7 to 10 years time frame, and that's clearly written within the contract. So it stays 100% passive.
Oh, yeah. Okay. Can you tell us why you're selling the property within 10 to 10 years? What's the motivation behind that?
It's purely financial. But if you in Belgium, when you buy a property, you get, I mean, in Belgium and everywhere in Europe, but especially in Belgium, you have a high acquisition cost, right? When you buy a property, you have to pay taxes at the notary. Well, part of it's notary fees, part of it is taxes to the government. More or less, it's 15% of the acquisition price. So that's one fee. Then you might have to renovate the house, and Scargo is also making a lot of work to crowdsource and to hunt for the property. So all of this has a cost and comes into the acquisition cost of the house on top of the house price.
Yeah.
So if I buy the house now with all those acquisition costs and I sell in a week down the line, well, I will lose money.
Yeah.
Because I won't have all the depreciation that I need.
Yeah, I'm mostly wondering, like, I feel like maybe you could hold it for longer. Is there a reason why you would want to sell at 10 years instead of holding 20 or 30? I don't know.
Yes, and then why we don't sell after 10
Yeah.
years? Basically, we're using debt to finance a property,
Mhm.
and that gives us leverage. The thing is, when time goes by, we're reimbursing that debt, and after 10 years, we have a lot of equity within the
Mhm.
property and lower debts, and it's better financially for investors that we sell the property, we get the capital gains, and then we reinvest that money within other properties with a lot more debt so that we
Mhm.
can increase the leverage. So it's basically a financial mechanism that enables us to increase the profitability and so the returns that we get to our investors.
And so you basically did the math to find the balance between cost of acquisition and then the benefits of leverage and finding the right time frame for selling, and that's around 7 to 10 years then.
Exactly.
And is refinancing, so injecting more debt into the property, an option, or does that not necessarily work because of multiple owners?
So at the end of the 7 years, there are two options. Either
Yeah.
we sell the property on the market, or we can refinance the property through a loan, and that we would mainly have to discuss with our banking partners. So it will be either one or the other.
Okay. Okay. Very cool. It's nice to see all those optimizations taking place to support, like, basically to improve returns. It makes sense.
Exactly.
Awesome. Look, maybe I mean, we've dove, I don't know. We went straight into the topic, and we've kind of skipped your the introduction. Could you tell us both a bit more about you, like why you started Scargo and what you aim to achieve? Like, what's the big picture here? Where do you come from? Where are you going with this?
Yes, of course. So actually, I studied business engineering at the Southern Brussels School in Brussels, and I wasn't really studying a lot during my master degree because I was spending most of my time managing about 15 Airbnbs for other owners across Brussels. So I was taking care of the cleaning, welcoming of the guests, and all those things. That was maybe the best student job I ever had. So it kind of gave me a first exposure to real estate. And also that was part of why I got this idea today. After that, I've always been an entrepreneur with a situation that typically do not fit for a bank loan. And I realized discussing with my friends and the people of my generation that it's a common problem, right? Either you don't have the capital to invest. If you don't get help from your parents, it's getting harder and harder. Or you have a situation where you're an entrepreneur, you have a half-time job, or a situation that for you that's not a CDI, we say in Belgium, so like a long-term job contract. It's hard for you to get started. So it made me really want to work on that problem, especially because it was people of my age, people around me. So that was easy for me to discuss it and to work on it. And then when I saw the economic context where prices are on the rise, where banks ask for more capital to buy a property, interest rates on the rise, it's all things that made me think, okay, this is the right moment to launch that kind of project, and this is a problem that is going to get bigger and that needs to be solved. So that's mainly how I started building this. To be frank, I thought it would be much easier than that, but that's always what happens to entrepreneurs. But now, like 8-9 months down the line, working on legal solution, we're ready, and the first property is will be open to financing on October 24th. So,
all right.
So 10 days from now, registering the podcast, and I hope it will be a big success.
Yeah, awesome. I mean, that's quite fast, I would say. 8-9 months to put it all together. I mean, I love, your story of basically where you're coming from with first identifying the problem, which is a common problem, of course, one that you have had yourself, but also the fact that you had the skills. It's a nice coincidence, but often that's how entrepreneurship starts. No, there's a good match between experience and skill sets with an actual problem that we go through. It's like that's how it started for me too in index investing. No, yeah. So I love your motivation, because it's the same as mine as well. Is how do we solve a problem that most people face and that at the moment industry is not providing a solution for. I think that's amazing, because it serves all the people who are a bit like us. So yeah, and I'm always impressed by entrepreneurs in general, because I now know what it is. And so huge respect to you and your past ventures, and then this new project. Like I'm hoping it's gonna go well. And so yeah, this podcast will be released a bit after the property is open for investors. So I'm hoping that by the time this is aired, that people can go and check it out, and maybe just let's go for sold out. No.
Exactly. I hope it won't be sold out already.
Hopefully, but if it's sold out, it means you go for another one, right?
Exactly.
So yeah, I'm guessing, so you're starting with one, and then you'll be adding properties gradually, so that people can basically be investors in several properties, right?
Yes, you said it before, right? When you invest in a property that you buy yourself, it comes with the risk of it's only one property in one specific market, and it comes with all kind of risks. So the idea is to rapidly acquire new properties and to provide a kind of diversification to our investors. So if investors have a budget that they want to put in real estate, we really recommend not to put all of them on the first property, but keep for the long term. So yes, that's going to be our focus, but one step after another. So first we finance the first property successfully, and then we'll add more to the platform.
Okay, and so with this, a lot of questions come to my mind. Like, where are the property based at the moment, and what's your plan? Where do you plan on having those properties, and how do you pick the places where you go find those?
Yeah, so for the moment and you have plenty of strategies to invest in real estate, right? The one we picked is the one I know well, which is to invest in the short-term rental market.
That's a very good point, actually. Yes. Let's go with that.
Yeah, you start there, but what and I think it's also very good asset class to do fractional investing. The reason I like STR, short-term rental, so much, so it's renting for a period of less than 30 days to business travelers and people that come for leisure. The reason I like that strategy is that first, it can bring you higher cash flow than standard rents, with a risk that's similar than a standard contract rate. Because if Airbnb is not working anymore, you can rent it. I mean, it's a normal apartment that you can rent with a classic contract to a person that will stay long term. So you always have that backup if something goes wrong with the Airbnb. So I like that strategy because it's a similar risk, but you can increase your cash flow for as long as it works. So you have higher cash flow, and then I think I like it for a fractional investing platform because it comes with very high barriers if you want to do it yourself. If you want to buy an Airbnb today, well, it's very, very hard to get a loan for an Airbnb because the banks usually don't take into account those kind of revenues. So you have get lots of discussions with the banks. Second, you have a lot of management. You have to welcome the guest, do the marketing of the property. You have to do the cleaning and people. And so this can take a lot of time. And then you have to have key knowledge because the people expect that they have the quality of an hotel now. Airbnb is so mainstream that it's not anymore someone renting a room within his apartment to make a living. It's getting more and more professional. So you have to have knowledge to do it well and to maximize the returns on your investment. So because it comes with those three big barriers, I think it makes a good case for fractional investing. And so that's one reason I wanted to start with that. So to respond specifically to your question, we're targeting markets that are interesting for short-term rental, and one of them is Antwerp. It's like one of the top cities in Europe. If you look at the RDNA data, so it's the service that's scraping Airbnbs to really give you data on which cities are performing or not. And Antwerp is a good case because the real estate price are not so high compared to the average night rate that you can get. And because in Antwerp you don't have seasonality, right? Like people comes all years round because people come from work as well as for leisure, and there is a high demand, so that makes it a good case. So the first property is in Antwerp.
Okay.
And then we look for other markets so people can diversify that are both with low seasonality and with a low risk of regulation also.
Yeah. So you have an interest in diversifying to basically provide stability and risk management, but I'm guessing you also have an interest in having several properties in like similar, like same city, maybe even the same neighborhood, maybe for management, like economies of scale. Is that something also that plays a role?
Yeah, of course. We're looking for markets that are big enough to have economies of scale, and to have a team that can manage the properties well. But I would say that's more the long-term vision of the company. Yes, the first interest is to have the best return and diversification for investors, and in that sense, we're going to go right away in different markets.
Okay.
So that the investors that invest in Antwerp today can invest in Ghent, for example, tomorrow. So first the investors' interest, and then we'll see how we can make economies of scale with Cargo.
Interesting. And would you rather target then? You wouldn't necessarily target people from Antwerp to buy the property in Antwerp. You go Belgium, like national. Okay, because I would see also another strategy. I'm not questioning your strategy here. You've done a lot more work, but like doing everything in one city and say, we're going to market only in Antwerp and we're going to make a portfolio of properties in Antwerp. And it will be easy to market because people know the place here. No, it's just, but this is a different business idea. Anyway, we don't have to go there. There's something else I'd like to bounce back on is the way you present. Obviously, I'm also have a bit of an entrepreneur brain now, a little bit. It's kind of starting to get there. But how do you present the opportunities to potential investors? Because we've called it fractional real estate. I guess that's not how you present it. How do you present this to potential investors?
Yeah, so basically, Scargo enables you to invest from €100 in a real estate property. That's how I am marketing today.
Yeah.
So that they can get a fraction of the rent and of the capital gains at the end without having to do any of the hassle to invest in real estate. So that's how I present it. Usually, the first question I get is, how does it work?
Yeah.
How are you buying those properties?
With €100, yeah.
Yeah, exactly. Exactly.
Okay.
So maybe to respond to that quickly, the process is quite simple. Scargo is hunting for properties that have a good potential for rental yield, so the rent you would get from the property, and capital gains at the end. We were looking at both. We add them, and that gives you the return on the investment you can get. Once we find a good property, we make an offer, and when that offer is accepted by the seller, we present the property to the investors. So during the offer and the sign of the deed, we crowdfunding. So Scargo for now is taking all the risk. Investors don't take any, and they can decide whether they want to invest in that property or not based on the business plan. So that's basically how the process works and how I present it to the community we have now.
So, for example, for this property in Antwerp, you already are committed to buy it.
Yes.
With the condition that you bring in sufficient capital from private investors, or is it going to happen anyway, even if you don't get those?
We could have had it a condition, but that would have lowered our purchasing power.
Oh, yeah.
So in this case, it's going to happen anyway, even though we don't have enough investors.
Oh, wow. Okay, so I hope you get all the investors you need.
That's how much I believe in my project.
Yeah, I mean,
I know how committed I am.
If it's a good cash flow, for sure, you just go for it. And if people want to be part of the journey, then good for them as well.
Exactly.
So the reason I was asking this is because, yeah, actually, I didn't click right away in our conversation, although I knew from before that it was short term, and I think I think something a lot of people, I mean, at least me, I've always considered real estate short term as maybe the way to go because I know it provides more revenue. It's better returns if you go short term. That's just what we feel it is. We also know that it's a lot more work because of the preparation, the management, and just the day-to-day taking care of the place. So I wonder if that's not another way of presenting it, saying, hey, you've always wanted to have an Airbnb, right? Because honestly, I think you could go with that question and most people are like, yeah, of course, but it's just hard, right? Yeah, it's hard. Well, here how you can start and you don't have to do anything, just own it. And I run it for you. I think that could be a different approach to present it. I think that to me, that seems more like, to me, that's more enticing. I don't know if that would be the same for the audience, but I think that's a strong point too, no? This Airbnb approach, short-term rental, high yield type thing.
Yes. I've had that question myself a lot. I'm scared to confuse investors, but the way you just pitch it, I really like it. So I might change my mind.
We're just, you are still in testing phase, so you can test things and see what works. But and yeah, I think that's like, I'm always looking for a way to explain to people how to be index investors. And one of the ways is, wouldn't you want all the super rich and smartest CEO in the planet to work for you? Just buy a bloody index ETF and then they're all working for you, it's it's a similar, like when you emphasize more on the highest benefit possible and how you can easily get a share of that. But yeah, I could also say start with the stock market with €100. It's just like I wonder if we don't appeal to different audiences by doing one or the other. And I think that could play a role as well.
That would be a good test.
Yeah, no, I haven't done the test either. But one day, one more idea on the list of ideas. Cool. Now, people are owners of those certificates, right? Where are they? Where like, is it a digital thing? Is it a paper thing? How is it held? Is there a registry? How does that work?
Yeah, so when the buying fractions of real on Scargo, there is a contract on the page of the property that starts running when you're actually buying digitally a fraction of Scargo. So it's a digital registration within Scargo database that's actually marking the ownership of the contract, and it's registered within the application that's totally secured, so they can see how many fractions they have, so how many real estate certificates they have, and in which property for which value. So that's basically how it works.
And so this application, that's a Scargo in-house application, or is there like a public ledger? Is there something that's like registered somewhere officially? How does that, like, how is this piece of ownership like confirmed by the law and all that? Or is it just the contract that basically states so many shares owned by such person?
Yes, it's just a contract.
Okay.
It's just a contract, and the whole application of Scargo is developed internally, so it's not outsourced, and we're taking care of all of it.
Okay, so the contract is really the strong part. People should keep a copy of that and say this is what certifies the ownership of the certificates. Okay.
Yes, exactly, and the deal that there is between the company that's buying the property and the investor itself. So I recommend reading that contract before investing. And
yeah.
if you have any questions, I'm happy to help.
Yeah, of course. Okay. And then certificate owners, can they do something with the certificate before the company, like the real estate gets sold? Is something that people can trade? Is something that they can sell back to Scargo if they want to exit early? And or what are the options for people there?
The dream we have is that we can buy back from the investors if they need like instant liquidity, right? That would be a dream, but we need time to build liquidity to do that. So what is very good about real estate certificates is that it's a debt instrument you can easily transfer to someone else without any legal nor administrative frictions that you would have with a real title of property. So you can sell it. Actually, you can even do it through a secondary marketplace that's called Euronext Expert Market. But you have to have a buyer that wants to buy your real estate certificate at the price that you offer. So what we recommend is that, of course, your returns will be maximized if you stay mid to long term, and hold as long as you can. But if you need your cash to finance a personal project before, you can of course leave and get out of the investment to selling your fractions.
Mm-hmm. So ideally, this is something to hold for long term. There is a way of cashing it out, but it's not necessarily simple, at least at first, while Scargo develops like a marketplace or something, right?
You actually, selling is simple. You can go,
but you need to find a buyer. That's what I'm saying.
Yeah, yes, exactly. The process is not too hard, but there needs to be a buyer. Then on financial markets, you always have a buyer, right?
Yeah.
It just depends at which price you put it. If you put your fraction at the price of 0, of course everyone will buy it. So what I mean is that your returns might not be maximized if you intend to sell in 2 years from now.
Yeah. No, of course. And it's still much easier to buy and sell a certificate than to actually buy and sell an actual property and manage it. So
yes, yeah,
like,
definitely.
This is a massive improvement. We're not comparing this to ETFs, which are obviously super easily tradable, which we shouldn't be trading, by the way. It's also buy and hold. But in terms of like ease of acquiring it, it's similar to buying an ETF on the stock markets. It's fairly straightforward. Yes, there's more reading to do in terms of the contract and all this, but there's also some learning to do on the index side of things. And then you buy and hold long term. Yeah, so that's, basically, I think one thing we should do probably is, I don't know, or later in the call, is go back to all of the drawbacks that I find in real estate and see how Scargo helps mitigate them. Because I think that's, for people who just don't want to be in the stock market or really want to be real estate investors, but they're facing all of these challenges. I think Scargo is bringing a lot of the solutions there, and that's really interesting. So what would you say, but before we go there, what would you say, what are you currently expecting in terms of potential returns for the investors here?
Yeah, so big note on returns. These are not on the platform, these are not guaranteed, right? So all the returns you're going to see are objectives, and they're based on very conservative hypotheses, but they still are objective based on the business plan that you have to read. And so these can be higher if the property performs better than expected, but they can also be lower if the property performs lower, right? Still, we're taking very conservative hypothesis, and it will really depend from one property to another. If I can give you a very concrete example, on the first property that we offer that will be open on October 24th, it's we are announcing 8.8% of returns. So that means that you invest €1,000 and you have a smaller computer on the page of the property that enables you to see how much you invest, how much you get. But if you invest €1,000, you get €88 per year, and that is divided in two parts. The first part is the returns you're going to get from the rental yield. So from it's basically the rent minus the charges minus the reimbursement of the loan that you're going to get on your bank account every month. And that is around, for that first property, €46 per year, but paid every month. So you're going to get around around €4 per month, right? Yeah, more or less.
More or less.
We won't do the math here. So that's the first part of the yield, and then you're hoping to do capital gains on the reselling of the house. So that's the second part of the yield. And because your fractions are going to increase in value. They're going to increase in value because we reimburse the rent every month. So financially, they take in value because there is more equity into the property. And the second mechanism that makes it increase in value is because the property, we expect the property to increase in value in the future. That's maybe where you need to be a bit more careful, because the hypothesis we took is that for the past 10 years, the property in Antwerp have been written for with a rate of 4.46% for the whole 10 years. And we expect it for the next 10 years to be the same. That's the hypothesis that's taken within that capital gains. So you might reconsider that if you're less confident into the real estate market in the future, and say, okay, I might have an increase of the property that is lower. Still, if the property price is not increasing, you will still get capital gains because we're reimbursing that loan that makes the value of your shares increase over time. So to sum up on that, you have €88 if you invest €1,000, €46 from the rental yield, and then I expect around €42 from the capital gains that you might have when we're selling the property.
Okay, so I think so. There's different parts to the returns here, and it's nice that we're going through this and break it down. So there's the cash flow, which goes to the account of the certificate owners. Is that something that happens monthly? There's cash transfer. Is that their own bank account, so they provide an IBAN and then it just gets transferred, or is it on you have a cash account somewhere in Scargo? How does that work?
It's their own bank account.
Okay, so there's a transaction that's made to all the investors every month based on the net rental profits, right? After paying for the mortgage, and loans and all that, and then there's an increase in value of the share through two mechanisms. One is the reimbursement of the debt, which is done from the rental income, the part that is deducted from the net cash flow. So that doesn't get distributed, but gets put back into increasing the equity value of the share. And then the third mechanism is the increase of just the capital increase, so the increase in value of the property over time. So that is something that is not either. So the part that is distributed is the net rental profits. Then there's a part of rental that goes into paying back the loan, and then there's a part of capital gain. And the last two are, you don't get the cash. You get them when you sell at the end. And obviously the assumption is that that's going to be a net positive with growth of the value and all that, which can vary. But this is, I mean, I think it's a decent expectation, but it can be challenged, but we don't know, right? Basically, we don't know. That's the future. The one thing that we are quite confident about is short-term cash flow, because typically those, I mean, I'm assuming you'll be investing in places where you know that's working, maybe even buying properties that are already rented and performing. So there's, or maybe not. No, I don't know what your strategy is there, but basically that there's a higher certainty on that, on the cash flow, I would say, than on. And the other one has fairly high certainty too, in the sense that yes, there will be an increase in value, at least from the reimbursement of the debt, and then long-term growth of capital gain for the value of the thing. But it gets realized at the point of sale, right?
Yes, exactly. You actually getting the cash. So the capital gain, you're getting the cash. It's realized either when you're selling your fraction to someone else, or if you're waiting the sale of the property. So
Okay.
when I say you get 42 euros of capital gains, it's imaginary, right? You don't get it on your bank account.
And the reason I'm bringing this up as well is because I would imagine that is correct for the first year, but as growth compounds, those numbers could be different. When the same share is worth twice as much.
It's annualized, right?
Yeah.
Because
So
even with the debt reimbursement, it varies. So it's really we're looking for 10 years and we annualize that return, and we say it might be, if you hold it for 10 years, 42 years.
Yeah. Interesting. One interesting graph that could help is, I've seen the interface. One is just showing the curves, like with the different.
Yes, right.
That could be interesting to see. That's how I also try to show things with index investing. And because you could provide a breakdown there and show what's cash flow and what's like increasing actual value, reimbursement of debt and all this, I think. Because I was trying to figure this out. But yeah, it makes complete sense. So yeah, there's several places where there's value creation. That's quite awesome. Okay. What else do we want to talk about? We've covered a lot already, but
we've covered a lot. Maybe we haven't covered taxes, right?
All right. Yes. How does that work from a tax perspective?
I would say taxes and the business model of Scargo. So we're fully transparent here. So with taxes, it's important to understand that the revenues are considered by the financial authorities not as real estate revenues, but as financial revenues. The same as if you would buy a bond or a share of a company, right?
Mm-hmm.
In that sense, the only tax you will have to pay is a withholding tax, or précompte mobilier, we say in French, of 30%.
On the dividend distribution.
Exactly, on the dividend distribution. So it's not really dividends, but it's more interest.
The cash flow.
The cash flows, and on the capital gains, but not on the reimbursement of your capital. What that means is that if you invest €1,000, you will never pay taxes on those €1,000. You will only pay on the capital gains that you might do. So if you resell your fraction €1,500, for example, and on the interest that you get. And the last thing is that those real estate certificates have a specific tax regime, in the sense that the company is not going to pay. There won't be a double taxation in the company and in the individual. So the company doesn't pay taxes on those revenues, only does the investor. So you don't have a double taxation.
Yeah. So from the company perspective, these are costs that are basically, it's the distribution to investors, that's costs. So the company itself is quite tax efficient, and then it's fairly tax efficient for the investors as well, because it's fairly tax efficient. I guess it's 30% on any gain, right? It's 30% on the cash flow, 30% on the gain, and that is different from stock investments, for example, because there's no tax on capital gain for stocks. But in this case, it's not a stock; it's an instrument of debt, right?
Yes, exactly.
So the rules for debts and bonds apply, and there is a 30% capital gain tax on bonds. which applies here to the capital gains for the certificate. So yeah, that makes complete sense. So there's a 30% flat
Yes, exactly.
tax on gains
tax.
from the investor perspective, and on Scargo side, or the real estate business side, these are all considered costs, so you can function quite tax efficiently. It's pretty good, huh?
Yes, it's a system that has been there for a while. Because one solution we had thought about was to have to that actually investors would be owners of the company, but then that means that you would have to distribute dividends, and it would be very hard because those you have to tax then the revenues, then distribute dividends, and the individuals are taxed on those dividends again, so there would be a double taxation, and that we really wanted to avoid. So that's also one reason why we picked the real estate certificates.
Mm-hmm.
But
Yeah, and since you're paying less taxes at the business level, you can distribute. There's also a way of distributing more of the profit, because basically the whole thing is equalized. So although it's a 30% tax for the investor, you still get higher revenue than if there were taxes to pay, like at a higher level.
Yes,
I would imagine. And then, so the 8.8% forecast, that it would be excluding taxes. Taxes would have to be paid on that, right?
Yes, taxes would have to be paid on that. The reason we show them we show gross returns is because all product investment do, so it's easier to compare. But yes, you have to pay taxes, and it's for all Belgian investors, Scargo is taking care of it for them, so they won't have to do anything. They won't have to declare those.
So you're withholding it, yeah?
Yeah, wow. We're really withholding it. For foreign investors, they would have to do it by themselves, but we have helped them down the process, especially for French.
Yeah, and sorry, there's another question that was coming from this. I just lost it.
Sorry.
Yes. Sorry, it's an important question. So in recent times, as we were discussing earlier, there's been a very high inflation. Are you then the numbers that you're looking at are these nominal returns or real returns? Like, how do you see this evolving with inflation? Like, is this 8.8 nominal with inflation of 10%, or is this in times of 10% inflation, this is like 18.8 or something? Like, where does this?
Yeah, those are nominal returns, not real returns. What I expect in the future is that the dividend yields, or the rental yields, to be precise, we will actually follow the inflation as we're renting it to tourists and business travelers. Actually, the night wage should increase or should follow the inflation, but I cannot predict the future. But that's what I strongly believe, and so the returns the real returns will follow, right? That's what I expect. Now, what will be the impact of inflation on the real estate prices? Very, very long term. That again, I cannot predict the future, but it's not predicted that long term the real estate prices will go down. We've had inflationist context where the real estate prices actually hold, and so even though in the past months or the following month we expect a bit of disturbance, I'm quite confident the real estate market will hold. But again, I'm not an economist on that, and everyone should have his own opinion.
Yeah. But usually real estate long term tends to follow inflation, so that should be pretty okay. No, so I think it's fairly positive, and inflation is the same problem for in all types of investment. Is you still try to do the best you can, and then inflation does whatever it can.
Yeah, exactly.
But those who don't invest, it's better to invest.
Losers anyway.
You still have to invest to try to beat inflation, and then that's it. So it's the same game, we still do the same things. All right, this is very interesting. And then maybe tell us a bit more about the business model of Scargo and how you're structuring that.
Yes. So the business model is quite transparent and straightforward. We kind of work like a real estate agency in the sense that we're taking a first fee at the acquisition of the property. We're taking 10% of the purchase price, that enables us to cover the searching from the property, the management of the renovation if there are any, and the financing operation. I would say that requires marketing and work to bringing in like 200 or 300 investors to work toward to finance a house together. So that's the first fee that we take. Then we also take 1% of the property value per year that's deducted from the rent to do the management of the property. So I'll give an example. We'll send updates on the houses to investors every month to see, okay, this is what we did to the house. This is how it's performing. All of these are as costs, of course, and we're covering that with that 1%, which isn't very, very high, which is not impacting the returns that much. One thing that is important is that both fees are included in the returns that we present on the website.
Mm-hmm.
So when we say 8.8%, it includes all Scargo fees. The only thing that it doesn't include are taxes.
Mm-hmm.
So that's how it works.
Yeah, and that seems fairly low for the amount of work you still have to do, because now I'm guessing you deduct management costs as well, or is that part of the 1% property price that you take for managing it?
Oh no, so here you managing the property in Antwerp, for example, we require cleaning, welcoming of guests.
That's a lot of work.
And that's a lot of work that we couldn't cover with 1%.
So that's a cost that's part of the investment.
Yeah, that's an extra cost, and then on top of that we have a 1% for Scargo.
Yeah.
Because actually the management of the property can either be done by Scargo or outsourced to a property manager. It's more Airbnb manager in that case. And for the first property in Antwerp, we picked a Airbnb manager that knows the market very well, because we expect to get higher returns this way. It looks very professional considering the Airbnbs of him that I've visited. So he's of course invoicing a certain fee that's market rate. Usually, if you look at companies that do that, is 20% of the rental revenues. So that's the cost of that's deducted from the rent. So to sum up, the Scargo 1% comes on top.
Mm-hmm. Yeah, it makes sense. This is Scargo management fee. Yeah.
Yes.
Very good. And so at the moment, Scargo is you, and I guess you have you mentioned lawyers and notaries. Who else is in the team? What's your expectation there?
Yeah, so I didn't start alone actually. I'm usually the one pitching it, but I've got a lot of help from lawyers, from people that know that have specific expertise in real estate, and from Kylian Jolin, which is of course you know him well, who I co-founded Legacio with, which was my previous venture. Nothing to do with real estate, but it was an alternative to the notary that's more for everything related to estate administration. So when you face debt in your family, that was a topic that was also hard, but we thought we could improve the experience for all those families facing a death in their family. Anyway, I built that with Kylian Jolin, who is still helping me a lot in the marketing and communication today on Scargo with joining the team. And then we hope that together we'll raise funds by the end of the year, so we can build a team and improve the platform, bring in more properties, but again, one step at a time. And next milestone is that property on October 24th, and that we hope to make it a wide success for 200 or 300 first investors.
Okay. So it's you and Kylian. Kylian is a good friend of mine too. So yeah, it's awesome that he's also involved in this one with you.
Yes.
Kylian's awesome. And so so you're going for first property now, then you're probably gonna add a couple more, and you're going for fundraising end of the year, and then what do you see the future like?
Yeah, for fundraising, and then we hopefully next year we'll be at least able to fund one property per month to investors. if we manage to do that, we consider going abroad also. But again, I prefer not to rush into growth. The priority is to make customer success that's excellent. I want investors to have answers to their question quite quickly, and really to feel that there is a team behind that's supporting them in their investments and in the decisions they take. So that's my first priority. I want the properties to keep the same quality over time. And so when those two things are really set, I would say, then we probably get into growing mode and try to make Scargo available to more investors, but we're taking our time.
Awesome. Are there other alternatives in Belgium doing something similar to Scargo?
Not that I'm aware of. There are alternatives in other countries. In Holland, you have no, in Netherlands. Sorry, Holland is in French. You have BRX app. I don't know how they pronounce it, to be frank, but that's also providing fractional real estate. We're inspired by them. Then you have a US company that's called Realt, that does it on the with the blockchain. So they actually selling tokens that represent a share of a property in the United States. There are companies doing more or less what Scargo is offering. We'll probably dive into the blockchain later down the line. If that can, the condition that it can increase the liquidity of the instruments that we provide, and maybe the security. But for the moment, I don't see that as a priority, especially because I would have to explain on top of this is fractional real estate that this is a blockchain product, and that's not something I want to get into too fast.
No, I understand. It's harder to explain how that would work to people who are not tech savvy.
Exactly.
So would you say there's examples of like fractional real estate companies in the US or somewhere else that's like maybe good inspiration for you guys? Or
yes, it is definitely good inspiration. We're not reinventing everything here. We're just making it. We're making it available, and we hope better for the Belgian investors. One big one we're following is Arrived Homes. So it's one US company that started a few years ago, that's been financed by Jeff Bezos, but that's not the most important part. But that's really built an interesting model for everyone to pick the properties they want to invest in and buy a share. So yes, we get a lot of inspiration from foreign companies in other countries to try to build a better version here, or at least to make it accessible to Belgian investors also.
And it's good to see other being successful at delivering, good results for the investors, so that you can go and do something similar or better. Yeah, for sure.
Exactly.
It's also reassuring. The reason I'm asking is I don't want people to think that this is like you're the only one doing this and you're trying to figure out a way to make this work. It actually works in other markets. It's just fairly new here in Belgium. And that's what you're doing here, is basically figuring out how to make it work here and provide the same benefits to investors as already exists in other places. And I think that's quite important. And one thing that's quite important to my audience as well, and the way I present personal finance and investing, is the risk aspect. So I'd love if we could go through the risks that are involved here for the investors, understand them, compare them to traditional real estate as well. But just, I think here in all transparency, like what do you see are the main risks and how do you manage them?
Yes, you have risk whatever the investment product, right? So of course you have risk with Cargo, and I would say that first there was a real estate risk that's quite similar if you were buying a house by yourself. So if you buy a house and you don't have tenants, or here in the short-term rental the performance is lowered, then of course your returns will be impacted if the house prices don't go as high as you had expected. Your returns will also be impacted. So that's the kind of risk that you have if you buy a property by yourself. You also have it with Cargo.
Maybe I would say, Scargo's professional approach to it probably mitigates a lot of that.
Yes, exactly. We try to mitigate those by having a professional approach, by selecting good markets in Belgium. So and also by providing diversification, right? That's again, I really stress that, but you can invest in several properties, and that I think that's important. So I would say that's the first risk, real estate risk. Then I often get the question, what happens if Scargo goes bankrupt? They see the Scargo's activity as a risk. Well, first, we don't plan to go bankrupt anytime soon. And we run the company safely, and we're here for the long term. But yet we planned the case anyway, where there is really a separation of the risk. So there is one company holding a properties, and see if and it's different from the company where I am, and I'm doing marketing, and where the risk might be different than investing in real estate, right? So there is really a separation of the risk. And the worst case scenario, if Scargo goes bankrupt, we have to sell the properties. So we sell the properties, we reimburse the only debt that there is, which is the bank loans, and then we pay back the investors with the amount of money that's left. So if that happens in a short time frame, so if you invest in a property and 1 or 2 years down the line, this happens, where you actually indeed might lose a bit on your investment, because we won't be able to resell the property higher than the investment you made at first. So we haven't paid all, we haven't depreciated, I think that's how you say in English, all the acquisition fees. So that's the risk that you take. That's worst case scenario. The case where you're losing 100% of your investment, I don't believe it really exists, because you will always get what is left after reimbursing the.
Yeah, I think this is an important aspect. The fact that you're segregating, so you have Scargo management is one company, and then there's the real estate company that owns the actual real estate and also issues the certificates, right? But the management company simply helps first market that and manage a company and take care of clients, like customers and everyone basically that is an investor. But the holding itself is separate, right? So if Scargo were to have issues, the holdings aren't touched. Like the balance sheet is separate. Like you have your own accounting, and the you manage that, and the companies pay you. That's the 10% plus 1% annual fee, right? And you do everything so that it works. And then here, the ownership, that's still you and the shareholders of that company, but you have shareholders of each of the individual real estate projects, which are the certificates owners.
Exactly.
Now, if one company was if this one was to suffer, what wouldn't work is there's no management for the holding company anymore. So I guess, yeah, you'd be forced to sell or to find another management company that would take over, or to refinance, or find ways to solve a solution, to find basically a solution to that management problem. And if you don't find the management, that's my perspective. I don't know if that's really what you say, but tell me if I'm wrong, right? But it doesn't mean that this will pay that, right? You don't get money from the real estate properties to save Scargo management.
Exactly.
But these might be forced to be sold. And the risk is, if that happens early, then you don't recover the cost of acquisition, which is the 15% plus all the setup plus all of that. But if it does happen in 10 years, most of that will be recovered through cash flow and capital gain. So investors would lose. Well, the likelihood would be much lower. I think there's still a scenario where even in 1 year, investors still come out on top. And that is if you have good cash flow and for some reason the property appreciated by 10, 15%, so that to cover basically the cost of acquisition. And with the leverage that you use for a year, maybe that's enough, right? I think there's still like the scenarios where that would still work. Obviously, we don't want to plan for scenarios where you're not they're doing this in a year. I want this podcast to be evergreen. I want this to be available and valuable for the next 10 years. So you have to stay.
Yes, I hope
You
so.
have to be super successful now. You
Yeah,
have no
that's what
choice.
I'm betting on. No, no, of course.
And then the final part is individually, each property also holds specific level of risk. Because something could happen at the regulatory level in that specific city. So, for example, impacting short-term rental and forcing either higher costs or making it non-viable, moving to longer-term rental, which would still be valuable, right? Long-term, it would still work since you're still selecting properties that are highly attractive anyway.
Yes.
And I think I wonder if like total catastrophe type scenario, there's floods or fire, and obviously the property is insured. So there's a certain level there's a certain part that's recovered in case of total like sinister. But I guess that's extremely rare now in Belgium. And but that could still happen, right? What happens then in those cases? Is it just we liquidate, claim as much as we can from insurance?
Yeah. Well, there was different type of big costs that we could have. There is renovations that you might have to do. That's one type of cost, and then you have like incidents like fire. That's a different type of cost. Regarding renovations, when we buy a house, we visit it with an architect that budgets the renovation we might have to do in the future, so that we provide I would say a stock of liquidity.
So you set money aside as the property runs,
exactly.
yeah.
We set money aside that will help us face renovation that we might have to do for the next 10 years.
That stays with the property holding, or is that under Scargo?
No, within the property holding.
Yeah, so it's not part of the 10 plus 1%.
No, it's on top.
Separate. Yeah. Okay.
Separately, and a little part of the rent goes to that provision also.
Yeah.
To make sure that long term it's growing and we have enough liquidity to face any issues. Yet if we have a fire or an incident like that, of course we're insured. So we go to insurances and try to get as much as we can back. But we might have to liquidate the property and give back all the capital to investors. But hopefully we can recover the house and keep selling it.
So in most cases, investors recover most of the value that they paid in. There's only a few scenarios where they would actually get less than what they actually put in, right?
Yes, exactly. Those scenarios exist, and you have to be aware of. It stays investing and comes down with the risk, but yeah, the likelihood of them to happen is quite low.
Yeah, in the last 20 years, we haven't really seen anything like that in Belgium. But yeah, rents and property prices could go down in a specific neighborhood for, over the period of 10 or 20 years. That could happen. There's been cities that just didn't do so well, or neighborhoods that really went down south because of some other issues, either politics or some other structural stuff that happens. And so that's another risk. But yeah, typically in Belgium, we haven't really seen that, I think. But there are examples. Certainly in France, for example, I know that there's like most agglomeration, like such as Paris and the big cities, rent price tends to go up, but a lot of places also have prices going down, and they're just not the places that we talk about when we invest, because there are more the rural places, maybe specific neighborhoods that just don't do so well because of there's lack of infrastructure or lack of some other things. But yeah, I guess that's going to be your main job, selecting the right place to do the right investment and avoid those that have to mitigate that. Yeah, for sure. Okay, what other risk do we need to cover?
I think those are the main ones. The real estate risk, the risk of Scargo.
Yeah.
What happens if Scargo go bankrupt, and what happens if the properties that they're performing as planned. I think those are the two very big ones to keep in mind. Yeah,
so that's interesting. So basically, what Scargo does is provide. I think now we can go back to like the challenges of Scargo, because not the Scargo of real estate, the way I see it. I'll tell you. We can go through them, and then we'll say how Scargo basically manages that, right? One that I listed some of them earlier, but basically Belgian tax is also something that's kind of heavy on real estate, I would say, compared to index investing. In this case, Scargo brings basically a different approach to taxes, because it's a debt instrument with a 30% tax on on whatever income or gains you make. So that's a bit different. Is that a plus or minus compared to traditional real estate?
It really depends on your situation. It really depends on the situation because the taxes you pay depends on the revenues you get, and those include real estate revenues. So it really depends on your situation. But
also, I think at the moment taxes on real estate, they're fairly high on the transaction because of cost of acquisition and all that. But also at the moment it's on revenu cadastral, which is like a fictive income, but that could change as well, right, in the future.
Yeah, that is if you buy as an individual.
Yeah.
Not that you buy as a company.
Yeah.
And it is in discussion to change that also. So it's not something new. So the plan is to bring the base of the taxes should be the real rent and not the home cadastral.
Yeah, we'll see where that goes. But I think that would be a bit more fair too. And including adding taxes to stock market investing, I think it also would be fair. But we'll see where that goes. Other challenges that I find in traditional real estate is obviously the ease of implementation. It's not easy to actually do real estate investment on your own the traditional way, and I think FIRE Scargo brings so much in terms of making that simple for investors. So that's amazing. I mean, you don't have to go hunting on your own. Someone does it for you. You don't have to bring 10, 20,000, 30,000 plus pay all the transaction fees. It's kind of taken care of. You can start with what's the minimum investment in Scargo?
100 euro is the minimum. You can invest until 5,000 euros.
Okay, so max 5,000 per property, right? Property. No, interesting. Why not let people go for 10, 20,000?
Well, there are two reasons. First is to let everyone to invest. So the whole idea is not to have one or two big investors buying the house, but to have 100 or 200 per properties. The second one is a regulatory reason. Because we're maximizing the 5,000 property, we are in an exception of a law that's called the loi prospectus. That prevent us from having to publish a big law document that would be very expensive for us to do, and so that's the only reason. So I would say regulatory and enabling everyone to invest, which is part of the mission.
Okay. Yeah. Plus, it allows people to then diversify across different properties and kind of force them to diversify by limiting how much they can go into one.
Yes, exactly.
All right. I find real estate very inflexible. It's once the money is in, it's in there, and if markets are bad, you need to sell, or if you need the money, it's really complicated with traditional real estate. Here, I think there's more flexibility in terms of how you can get in. And then, you're not supposed to sell fast, but at the same time, you can if you really have to. You just have to find a buyer and make the transaction, right?
Yes. Totally agree on that.
So there is some flexibility. It's probably easier to do that than to actually sell an entire property at the time of crisis and potential loss and all that. Yes, I mean, I think so. It seems easier. So certainly more flexible. Starting capital, there's no discussion here. Obviously much better with Scargo than traditional real estate. Time to maintain, well, there's almost no work with there's no work with Scargo.
No.
Time to start
reading your mails.
Yeah, just read your mails and that's it. The time to start, it's also very fast, almost instant, right? You just read what you want, and once you've read the whole contract and you're confident, you can get started, right? It's much faster than traditional real estate. Returns, I guess for the amount of work you do, it's solid returns if you know what you discussed is actually materializes. Because in real estate, you can actually make really good returns, but it's a lot of work upfront and sometimes during, especially if you go for short-term rental. So I think that's also a clear improvement there. Diversification.
Maybe a comment on that. I think if you, on the returns side of things, I think to be fully transparent, if you buy a property yourself, you might be able to get higher returns. You might, if done well and with a similar strategy, because you might have to be able to get more depth than a company like Scargo would, because you're showing the bank more revenues. Scargo is only showing the the revenues you get from the rent, right? So you might have a leverage that's higher, and so a risk that's higher, but returns that are higher also. So you might approach 12%. If you do it by yourself, where Scargo it's a little bit higher. So I want to be transparent on that. With Scargo, you don't have to do anything,
Yeah.
but the risk is a bit lower because we have a leverage that's lower, and the returns are a bit lower than direct investing.
Yeah, I think that makes sense. Yeah, good summary. So certainly, I think it's positive. Like, yeah, I mean, if you want more work and more returns, you still can through traditional real estate.
Exactly.
For sure. Diversification, I find that usually that's pretty poor real estate, and I think here you introduce an interesting approach to that. Once there's more properties available to invest in, so that's really good as well. Familiarity. I mean, most people understand real estate the traditional way. I think it will take some time to educate a few people on how it works through Scargo, but it's still easier to explain that than to explain stock market index investing.
Yes, yes, indeed.
Yeah, and it's practically passive. So, man, you check a lot of boxes with this new approach. It's quite amazing. Yeah. Yeah, that's really good. It's really, really good. I don't know if there's anything else that I wanted to compare there. I think we've covered all of it. Were there other topics that we wanted to talk about?
Looking at my notes right now, I think we've covered the majority of them. I think what you did is a great sum up of how we're trying to improve the direct investing of real estate, making it accessible to anyone. And I think index investing is a good solution. Also, maybe a bit harder for people to understand. That's maybe the advantage we have here. It's more tangible and easy to understand. But I think we've covered it all, Sebastian. And thank you very much for having me today.
Thanks for coming, François. This was amazing having you on the podcast and learning about this, being able to ask you questions. I always admire entrepreneurs, especially those who are, taking on a massive challenge of changing an industry, and that's kind of what you're doing here. And I see the benefits, so I was happy to share this message and this new adventure with the audience. I want to be very clear as well with the audience. Full disclaimer, I'm not an investor. I don't have financial interest in Scargo. I'm doing this because I think it can be an interesting addition to a portfolio. I still believe index investing as the number one way of doing this. Scargo is, I think, a new interesting approach to invest in real estate. At the moment with small amounts of money, but as you grow, this could become also a sizable part of people's portfolios. So I would encourage people to research fractional real estate in general. Take a look at Scargo. Have a look at the current deals, and follow François and follow Scargo on all social media. We will post all of those links in the description, so you can find them there. And who knows, maybe one day we do an index fund with all Scargo properties or something like this. No, but look, François, that was amazing. Thanks again. And I'll see you soon. Unless you have a final message. I don't know if that's even.
No, I'll just say go. I mean, hopefully there is still a few fractions to buy from the property on October 24th. So jump on the clubscargo.com.
Yeah, when this goes live, yes.
When this goes live, and hopefully you can get the shares too.
And if you're listening to this much later, maybe in 2023 or 2024, have a look at Scargo. Hopefully they're still there. No, but I'm expecting there to be a lot more properties available to investors. So that's what I'm hoping for you guys. And so yeah, all the best of luck. Good luck with the launch.
Thank you.
Happy investing and happy business.
Thank you, Sebastian.
Take care, François. That was such an interesting conversation. I've learned a lot, and I hope you have as well. Fractional real estate is something that is quite new here. So I think it's interesting that we explore this topic, and I'm sure we'll get back to it at some point in the future. But something that I wanted to emphasize on, and it may seem obvious, but just to be sure, this is not financial advice, right? Neither me nor François are financial advisors. We are here to share our knowledge and our understanding, but you have to do your own research, right? When investing in anything, really, you have to do your own research. first, understand the risks, understand how you could make money, but also understand how you could lose money. And unless you have a strong understanding, a good understanding of how you could lose money and what that would mean, and unless you're really ready for it, then don't invest, right? And that could mean also being understanding that things could go up and down, but being ready to hold on to it long term. So that's the case for index investing. I would say nobody can better take care of your money than yourself. So understanding is really important. And with that is the end of this episode. Thanks for listening, and thank you for tagging along on this learning journey. I hope you're enjoying this. And if you've learned something new in this episode, something interesting, or if you have any questions, please ask in the comments or ask on social media, tagging myself, Sébastien Aguilar of FIRE Belgium, and we'd love to hear from you. Right, that's it for today. Until next time, take care. Cheers.